Imagine waking up tomorrow morning and discovering that every single financial record tied to your name has just been completely wiped clean.
Right, like totally erased.
Exactly. Not a penny stolen, but your credit score.
Yeah.
Gone. Your tax history is erased. The digital trail that proves you get a steady paycheck, it just no longer exists.
Yeah, your ghost.
You are functionally invisible.
Mm-hmm.
If you walked into a bank to get a car loan
Yeah.
or even just to open a basic checking account, the system wouldn't see a hardworking person.
Yeah.
The algorithm would spit out an error, and the security guard would basically show you the door.
It is, well, it's a terrifying thought experiment for anyone who's, used to living in a developed financial system.
Right.
But for a massive portion of the global population, that is not a hypothetical scenario at all. I mean, that is just Tuesday. The reality of being locked out of the formal financial sector, it dictates literally every single choice a person can make about their future.
And that actually brings us to the core mission of our deep dive today. We are looking at Mexico, specifically, flashing back to the year 2002.
Which is such a fascinating time for this.
It really is. At that time, a staggering 70% of the population was entirely excluded from the banking system. Just think about that. 7 out of 10 people you passed on the street had no credit, no formal collateral, and they operated entirely in the informal, cash-based economy.
Which sets up one of the most, I think, fiercely debated questions in modern economics. When you have this massive population living on the edge of poverty without any access to capital, what happens if you suddenly give them loans?
Right. Is it a cure or a curse?
Exactly. Is injecting credit into an impoverished, informal community a magic bullet for social mobility? Or, as many critics argue, is it a predatory debt trap that just drowns vulnerable people?
Okay, let's unpack this, because to answer that, we are tearing into a landmark 2014 study. It was published in the Journal of Finance by researchers Miriam Bruhn and Inessa, coming from the World Bank and the University of Hawaii.
And what's fascinating here is that they tracked an event that completely shattered the conventional wisdom of high finance.
It really did. But to understand how you fix a poverty crisis that big, you don't look at a massive government bailout. And you don't look at a shiny new Wall Street initiative. You look at, of all things, a furniture store.
A furniture store, yeah. The premise sounds absurd on its face, but the data they uncovered tells this remarkable story about human behavior.
So set the scene for us. What exactly happened in October 2002?
Well, an institution called Banco Azteca did something that literally set a world record. They opened more than 800 bank branches almost overnight.
800?
Yeah, over 800. They instantly became the second largest banking network in Mexico. Just boom, right out of the gate.
Just the physical logistics of opening 800 banks in a single month is mind-bending. But the kicker, the really crazy part, is where they opened them.
Right, they didn't build these new, marble-floored buildings with giant vault doors.
No, they just walked into pre-existing retail stores called Grupo Electra, which was this massive chain selling televisions, refrigerators, washing machines, microwaves, and they literally just set up banking desks right next to the appliances.
It was a total masterclass in leveraging existing infrastructure.
Yeah.
And the target demographic for this new bank was precisely that 70%, that exact population that traditional commercial banks just refuse to acknowledge.
So we were talking about working class families earning maybe, $250 to $4,000 a month?
Yeah, exactly, in that range.
Now, here's where it gets really interesting for me. Because my immediate assumption is that traditional banks just didn't want to deal with small accounts, because the profit margins were too thin. Was it just pure corporate greed keeping those people locked out?
Well, profit margins are always a factor, sure. But the barrier was fundamentally structural. I mean, traditional banking is built on standardized risk models.
Right. They need the paperwork.
Exactly. If you want a loan, the bank needs a standardized way to predict if you will pay it back. So they look for W-2 forms, formal tax returns, a registered business license, maybe a deed to a house for collateral.
Which these people just do not have.
Right. The people in the informal economy, the street vendor selling food, the independent carpenter, the seamstress working out of her living room, they might make a perfectly decent living, but they generate zero standardized paperwork.
So to a traditional bank's risk model, lending to them is just a mathematical impossibility. The system is completely blind to their actual reliability.
Precisely. So the traditional system says no paperwork, no money, but Banco Azteca comes in and their marketing slogan was literally, "We changed banking, now it's your time to change."
They basically stood up and said, "We see you, the invisible 70%, and we are going to fund you." Which, I mean, makes for an incredible PR narrative.
Oh, it's brilliant marketing.
But as a skeptic, I have to push back here. Opening a bunch of desks in appliance stores is a great story. But proving that it actually lifted people out of poverty is a completely different challenge.
It's the hardest part of economics, honestly.
Right, because how do we know this wasn't just a lucky year for the Mexican economy? Like, maybe the whole country was booming, and these people would have made more money anyway.
And that is exactly what the researchers had to solve, because separating the impact of the bank from the overall noise of the national economy is tough. If you just look at a town, see a bank open, and observe that the town gets richer a year later, you really haven't proven anything.
Because, what, the price of oil might have spiked or something like that?
Yeah, or a new trade agreement was signed. You need a rigorous way to isolate the bank's effect. So what the researchers did, and what's so brilliant about this study, is they found a parallel universe.
Okay, a parallel universe. Walk me through how they actually set that up, because tracking an entire country's economic shift sounds incredibly chaotic.
So they looked at a sample of 576 cities across Mexico. And the key to the entire study hinges on the fact that Banco Azteca only opened branches inside existing Grupo Electra stores.
Oh, right. So they didn't actually choose where to put the banks.
Exactly. The decision of which city got a bank and which city didn't was totally predetermined by where a retail chain happened to be selling refrigerators back in the 1990s.
They were just stuck with the geography of the furniture stores.
That is such a random sample, it's perfect.
It is perfect. Out of those 576 cities, 249 of them had an Electra store, so they got a bank branch. The other 327 cities did not.
So this creates the perfect laboratory conditions.
Right. The researchers could compare the cities that suddenly received this financial shock to practically identical cities that didn't. This effectively neutralizes those macroeconomic trends you mentioned.
Because if the whole country is experiencing an economic boom, both groups of cities should rise at the exact same rate. Exactly. If only the cities with the new banks see a spike, you have isolated the cause.
Now, I remember looking at the baseline data in the study, the period right before the banks opened in 2002. And there is a detail there that seems totally counterintuitive.
The pre-existing trends.
Yes. The cities that were about to get the Azteca branches were actually performing worse than the control cities. Like between 1993 and 1998, their GDP growth was lagging behind. They were literally on a downward trajectory.
And if we connect this to the bigger picture, that specific detail is the anchor for the study's credibility.
How so?
Well, think about the alternative. If the cities getting the new banks were already the wealthiest, fastest-growing areas, a critic could easily argue that the bank just rode the coattails of an existing boom.
Oh, I see. They would just say the rich cities naturally got richer.
Right. But the data proves the exact opposite. These communities were underperforming. Therefore, if we see a sudden reversal in their economic fortunes after October 2002, it is impossible to dismiss it as a pre-existing trend.
Because the trend was going down, so any jump up has to be the bank.
Exactly. The trap was set to capture the exact impact of the intervention.
Okay, so the board is set.
Yeah.
The parallel universes are locked in. October 2002 hits, and 800 branches open their doors simultaneously.
It's an incredible moment in financial history.
And the very first thing that happens shatters a massive stereotype about poverty. Because the traditional men in suits assumed that people making a few $100s a month lived entirely hand to mouth.
They assumed there was nothing left over.
Right. The assumption was that if you are poor, you simply do not have the capacity to save a single penny. But that was proven wrong, immediately, wasn't it?
It was proven definitively false almost on day one. Banco Azteca introduced a savings account, but they designed it for the actual reality of the informal economy. They required a minimum balance of just $5.
Just $5. I mean, that is such a crucial psychological threshold.
It completely lowers the barrier to entry.
Yeah, because if a traditional bank tells you the minimum balance is $500 and you only have $20 left after buying groceries, you obviously don't put that $20 in the bank.
You hide it in a jar.
Exactly. You hide it under your mattress. You remain unbanked, not because you lack discipline, but because the velvet rope at the traditional bank is just way too high. A $5 minimum is like a permission slip to finally join the system.
And the response was just a tidal wave. In the first month alone, 157,000 of these savings accounts were opened.
Wow. 157,000 in 30 days.
Yeah, and by December, so just 2 months into the experiment, they had hit 250,000 accounts.
250,000 accounts. That is people literally pulling cash out of jars and bringing it into the formal light. But from a business perspective, what does a bank actually do when it suddenly has 250,000 new $5 deposits?
Well, they lend it back out, and this is where Azteca had a massive operational advantage over traditional microfinance institutions.
Right, the charities that usually try to help in these areas, they operate very differently, don't they?
They do. A traditional microfinance institution, or MFI, usually relies on donor funds, government grants, or really expensive international capital to fund the loans they give out.
So their pool of money is limited.
Extremely limited and costly to maintain. But Banco Azteca had a commercial banking license. They could legally accept deposits from the public.
Meaning they were using the community's own newly discovered savings to fund the loans back out to the community. They just unlocked local capital.
Exactly. It drastically lowered their cost of funds. They accumulated this massive, constantly replenishing pool of cheap capital, and they mobilized it incredibly fast.
How fast are we talking?
Well, the paper notes, their lending portfolio, exploded from 2 billion pesos in late 2002 to a staggering 10 billion pesos by the end of 2004.
A five-fold increase in 2 years. 10 billion pesos flooding into streets and neighborhoods that had been financially starved for decades.
And the average loan size was tiny, around $250.
So where does that ocean of money actually go? Because my traditional capitalist brain assumes that if a regulated bank enters a city, you are going to see a wave of formalization.
You'd think so, right?
Yeah. You would expect to see people registering businesses, getting tax IDs, putting up proper storefronts.
Because usually a bank demands formal paperwork, so the population adapts and formalizes just to get the money. But the researchers found the exact opposite.
Wait, really? The exact opposite?
Yeah. After the bank opened, there was no significant increase in formal registered businesses at all. That number basically stayed flat. Instead, there was a massive 7.6% surge in the proportion of informal business owners.
Wait, a 7.6% jump in informal, undocumented businesses.
Yes.
So the bank didn't create a glossy new corporate sector at all. It just poured gasoline on street stalls, the home workshops, the people selling food out of their kitchens. Why didn't anyone formalize?
Because the formal businesses already had access to credit. I mean, if you had a registered tax ID and formal collateral, you could already walk into a traditional commercial bank and get a loan at a lower interest rate.
Oh, that makes sense.
Right. Banco Azteca wasn't built for them. It was engineered specifically to underwrite the unbankable.
But a 7.6% jump in a couple of years is huge. Does that mean thousands of people suddenly got a $250 loan and decided to start a brand new illegal street business? Because starting a business is incredibly risky, even with a loan.
And here's where the methodology gets really fascinating. To answer that, the researchers couldn't just look at citywide averages, they had to look at panel data.
Okay, let me stop you right there for the non-economists listening. When you say panel data, what does that actually mean in practice? Are they just like surveying 1,000 random people one year and a different 1,000 people the next year?
No, and that is a vital distinction. What you just described would be a cross-sectional survey, which just gives you a snapshot of a crowd. Panel data means they track the exact same individuals over time.
Oh, wow.
Yeah, they're following, say, Maria the seamstress in 2001, and then checking back in on that exact same Maria in 2003. It allows you to see the actual trajectory of a specific human life, rather than just shifting demographics.
Got it. So when they looked at the actual individual lives of these informal business owners over time, what did they find? Where did this massive 7.6% bump actually come from?
They found that the surge was not primarily driven by a wave of new entrepreneurs boldly starting fresh businesses. It was overwhelmingly driven by existing informal businesses surviving.
Wait, surviving. So what does this all mean for the average person? I think we have this romanticized Silicon Valley idea of credit. We watch shows about venture capital and assume a loan is a rocket ship meant to take a small business and turn it into an empire.
Right, the unicorn myth.
Yeah. But you're saying that for a massive portion of the world, a loan is not a rocket ship. It is literally just a shield to stop you from going out of business.
It is a shock absorber for the poorest people in the market. Just think about the physical vulnerability of an informal business. Let's go back to Maria the seamstress.
Okay, Maria the seamstress.
She operates out of her living room. Her entire livelihood depends on one heavy-duty sewing machine. If the motor on that machine burns out on a Tuesday and it costs $100 to fix, what happens to her?
Well, if she has no savings and no access to a bank, she is completely wiped out. The business basically dies that afternoon.
Exactly. She shuts down. She drops out of the entrepreneurial class, becomes unemployed, and likely has to seek, low-wage manual labor just to survive. But if there is a Banco Azteca operating inside the local appliance store,
She walks in, takes out a $250 loan, replaces the machine, and she is back to work the very next morning.
the business doesn't die. The loan acts as a defense mechanism against the inevitable emergencies of life. That is why the proportion of informal business owners stayed so high compared to the control cities. The natural attrition rate, the businesses that normally would have failed due to minor financial shocks, it just plummeted.
That is incredibly profound. A loan stopping the bleeding of a community. So if all these small shops survive instead of collapsing, what does that actually translate to on a macroeconomic level? Did the overall wealth of these cities actually increase, or were they just kind of treading water?
The impact was definitive. The data shows that average income in the cities with a Banco Azteca branch jumped by 7% over a 2-year period relative to the control group.
7% in 2 years.
Yeah, moving the average income of an entire city by 7% in 24 months is a staggering achievement.
But, okay, whenever we talk about average income going up, there is always a catch. Usually, when a new financial institution enters a market and generates wealth, that wealth just pools at the very top.
The executives make millions, right?
Exactly. The executives and the large business owners make millions, the average goes up mathematically, but the people at the bottom don't see a dime. Did this intervention follow that same capitalist playbook?
It completely inverted the playbook, and this is perhaps the most face-slapping reality of the entire study.
Okay, lay it on me.
The researchers broke the sample down by income levels to see who was actually absorbing that 7% growth. They found that the income growth was almost entirely concentrated in the below median income group, the poorer half of the population.
Wait, what happened to the high-income earners in those cities?
They saw practically zero change in their income. The financial intervention disproportionately enriched the bottom tier, which means it actively shrank the wealth gap in those cities.
A bank opens and the wealth gap shrinks. That sounds like economic fiction. And we are talking about loans that average $250. To a Wall Street banker, $250 is like a fancy dinner. It's a rounding error.
It really is.
But here, on the street level, that exact same amount of money fundamentally alters the wealth distribution of a city. How is that physically possible? How does a tiny loan turn into a 7% citywide income boost for the poor?
Well, this raises an important question, right? To understand the mechanics of that, you have to look at what happened to the labor market.
Okay.
Simultaneously with that income jump, the proportion of not employed people, a category that includes both the officially unemployed and those who had just given up and dropped out of the labor force entirely, it fell by 1.4%.
So people who were considered basically a burden on society, people who were completely sidelined, were suddenly being pulled back into the workforce and becoming completely self-sufficient workers.
Exactly. Through two distinct pathways. First, some of those previously unemployed individuals used the small loans to start their own tiny stalls, immediately generating self-sustaining income.
Right. And the second pathway.
The second pathway is even more impactful. Those existing informal businesses we talked about, the ones that used the loans to survive and stabilize, they eventually expanded.
Oh, I see where this is going.
Yeah, the food stall owner buys a bigger refrigerator, handles more customers, and suddenly needs help. So they hire the unemployed teenager from down the street to wash dishes.
Wow. They created a localized microeconomy. The capital didn't need to trickle down from a massive corporation. It just circulated laterally among the people who needed it most. It is an amazing success story.
It really is.
But there is an elephant in the room here.
Yeah.
We have to address the massive glaring controversy at the center of this bank's business model.
The interest rates.
Yes, the interest rates. We are painting Azteca as this savior of the informal economy. But this credit was not cheap. If you look at the terms of these loans, it actually feels incredibly uncomfortable to praise them.
You are referring to the cost of capital. Banco Azteca was charging an annualized interest rate of roughly 40%.
40%. I mean, if my credit card company bumped my rate to 40%, I would literally cut the card in half and file a complaint. How is charging a struggling seamstress 40% interest not just the textbook definition of predatory lending?
It sounds awful, doesn't it?
It sounds evil. Why on earth were these communities rushing to celebrate a bank that was taking nearly half of their borrowed value in interest?
Evaluating a 40% interest rate from the comfort of a fully developed low-interest financial system completely misses the reality of the ground level. You have to evaluate the 40% against the actual alternatives available to that seamstress in 2002.
Okay, fair point. What were her alternatives? We already established that traditional commercial banks, which charge maybe 20 to 40%, simply rejected her.
Right. Her access to that 20% rate was absolutely zero.
It doesn't matter if the sign on the door says 5% interest, if they literally lock the door when they see you coming.
Exactly the point. So, what were her real options? If her sewing machine broke, she could go to a standard microfinance institution.
And what were they charging?
The paper notes that typical MFIs in Mexico at that time were charging interest rates between 60% and 90%.
Wait, 60 to 90%?
Sure.
Just to get a loan from an organization that is theoretically designed as a charity to help you.
Yes. And if the MFI turned her down, her absolute last resort was the local pawn shop or an informal loan shark, where rates frequently exceeded 100% annualized, and the penalty for missing a payment could be catastrophic.
Oh, wow.
So, when your daily reality is choosing between a pawn shop charging over 100% and an MFI charging 80%, a regulated bank offering 40% is not predatory. It is a massive, merciful market correction. It represents a dramatic reduction in the cost of survival.
Okay, when you frame it as a drop from 90% to 40%, it completely changes the narrative. For a carpenter with no proof of income, 40% wasn't extortion, it was a miracle. It's the best deal he had ever seen.
Precisely.
But that raises a massive operational question. If charities and standard MFIs had to charge 80% just to keep the lights on and cover their default rates, how did Banco Azteca mathematically manage to offer 40% and still build a highly profitable 10 billion peso lending portfolio? They must have had an unbelievable edge.
Oh, they had a staggering structural edge, and it was built on two secret weapons.
Yeah, what's weapon number one?
The first was an absolute information monopoly. Remember, Banco Azteca was birthed out of Grupo Electra, the appliance retailer. Electra had been operating for 48 years. For nearly half a century, they had been selling televisions, microwaves, and furniture on installment plans to this exact demographic.
Oh, wow. I didn't even think about the data implications of that.
Long before the concept of big data existed, they had built a proprietary database covering the buying habits and, more importantly, the installment payment histories of 4 million customers.
So while traditional banks were staring at these people and seeing zero formal credit history, Azteca was looking at them and seeing decades of verified reliability. They knew that the guy asking for a loan had successfully paid off a refrigerator over 24 months back in 1998.
Exactly. They had built a shadow credit score system.
It is the ultimate example of information asymmetry. They could accurately price risk, where traditional banks only saw chaos.
Right, but a database alone is not enough to enforce loans in the informal economy. You need a way to physically verify the reality on the ground, and this is their second, arguably more fascinating secret weapon. To process these loans and ensure repayment, they deployed an army of 3,000 motorcycle-riding loan officers.
Wait, I'm sorry, an army of bikers? We are talking about 2002. There are no smartphones, no sophisticated GPS tracking, just 3,000 guys on motorcycles riding out into the dirt roads.
That is the literal mechanism. It was an intensely labor-heavy, deeply local approach to banking. These officers rode out carrying handheld computer terminals loaded with that proprietary retail data. They didn't sit behind a marble desk waiting for the unbanked to come to them. They rode the banked directly to the unpaved roads and living rooms of their customers.
The imagery of that is just wild. No AI, no algorithms, just guys on bikes knocking on doors. But how does that actually solve the collateral problem? A bank needs something to repossess if you don't pay. An informal worker doesn't have a house deed, so the guy on the motorcycle repossessed a used television.
Sometimes, yes, the retail goods served as informal collateral. They looked at the TV you bought on credit last year to use as collateral. But the true genius of the motorcycle officers was social verification.
What do you mean by social verification?
If you applied for a loan, the officer didn't just check a database, they went to your house. They verified you actually lived there. They looked at the condition of your home to gauge your stability. And crucially, They would literally walk next door and ask your neighbors about you.
They asked the neighbors, like literally crowdsourcing credit risk from local gossip.
Absolutely. They would ask, is Maria a hard worker? Does her sewing business get a lot of customers? Is she reliable?
Yeah.
In a close-knit, informal community, your reputation is your most valuable asset. You can forge a document to trick a distant bank computer, but you cannot fake your reputation with your neighbors when a loan officer is standing in your living room.
That is brilliant. It is so thoroughly low-tech and gritty, but it's infinitely more accurate than a centralized algorithm trying to guess your reliability from a zip code.
Ew.
And I imagine that physical presence drastically changes the psychology of repayment, too.
It creates a powerful social enforcement mechanism. Defaulting on a faceless corporation through the mail is easy. Defaulting when the loan officer is a guy who rides his motorcycle through your neighborhood every Tuesday, who knows your neighbors and knows where your kids play, that carries a massive social cost.
Oh, absolutely.
It was this intense boots-on-the-ground verification that drove their collection costs down significantly. It was this combination of a massive historical database and hyper-local human enforcement that allowed them to offer that 40% rate and still make a profit.
It is a phenomenal corporate hustle that actually happened to align with the needs of the working class.
Right.
But let's zoom out from the neighborhoods and look at the macro picture. We have individuals surviving, we have local unemployment dropping. When you multiply that dynamic across the 249 cities that got these banks, did it actually change the economic map of the country?
The paper tracks this into the medium term, looking at the period from 2003 to 2008. And this is where the macroeconomic victory becomes undeniable. Remember our baseline.
Right. The cities that received the Azteca branches were historically lagging behind the control group cities in GDP growth, the parallel universe where things were slightly worse before the experiment started.
Exactly. Over that 5-year period following the bank openings, the economic trajectory of those cities completely inverted. The cities with the Banco Azteca branches surged past the control group in real GDP per capita growth.
They passed them.
They didn't just catch up to the baseline, they overtook the cities that had previously been outperforming them. The negative economic destiny of hundreds of cities was entirely reversed.
You literally bent the curve of a city's GDP.
Yeah.
And they didn't do it with a $1 trillion infrastructure bill. They did it by unlocking the capital that was already sitting there, hidden in the informal economy.
Exactly.
And it brings up a really important contrast. Why did this work so spectacularly when standard microfinance charities have been trying to do the exact same thing for decades with much more mixed results?
Well, it comes down to a word rarely associated with poverty alleviation. Synergy.
Synergy.
Standard microfinance institutions suffer from crushing overhead costs. If you want to start a charity to give out $200 loans, you still have to rent a commercial building, hire security, build an IT system from scratch, and run marketing campaigns. The fixed costs eat the capital before it ever reaches the street.
But Banco Azteca bypassed all of that.
Exactly. By operating inside an existing furniture store, the rent on the building was already paid. The electricity was on. The security guards were already at the door. The foot traffic was guaranteed because people were coming in to buy appliances anyway. The marginal cost of adding a banking desk to that environment was incredibly low.
And there was a behavioral synergy there too, right? Think about the friction of the transaction. If you get a loan from a traditional charity, you have to take the cash, travel across town, negotiate with a merchant, and buy the tool you need for your business.
It takes time and effort.
Yeah, but with Azteca, you get approved for the loan at the desk. You literally walk 50 feet down the aisle, and you buy the commercial refrigerator or the heavy-duty sewing machine you need from the exact store you are already standing in.
You are immediately converting the financial credit into a productive, income-generating asset. There is zero friction between the loan and the labor. It perfectly aligns the financial product with the physical reality of the borrower's life.
Which highlights a tragic flaw in how we usually try to help the unbanked. It's a perfect loop. If a bank doesn't understand your actual daily gritty life, what you need to physically do your job, they can never really help you escape poverty. They're just throwing money over a wall and hoping it works.
And Azteca tore the wall down by living in the same ecosystem as the borrower.
Which brings us to the ultimate policy lessons from this massive natural experiment. What does this teach governments and regulators today about solving financial exclusion?
The Mexican experiment gives the world a bold blueprint. And the primary takeaway from the researchers is that we have to stop relying exclusively on charity to fix structural poverty.
Because charity has limits.
Exactly. Charity is noble, but it relies on finite donor funds. Commercial viability, when structured correctly, can scale infinitely.
So the blueprint isn't to ask for more donations. The blueprint is to change the rules of who is allowed to be a bank.
The paper explicitly suggests that governments should actively encourage large retailers to get banking licenses. If a massive grocery store chain or a widespread telecom provider already has the foot traffic, the community trust, and the data on these unbanked populations, they should be empowered to provide financial services to generate that scale.
It's about utilizing the infrastructure that already touches the informal economy. But what about the collateral problem? The people still don't have house deeds.
Right, so regulators need to fundamentally broaden their definition of collateral. The obsession with formal property deeds excludes billions of people globally. The policy recommendation is to formally recognize informal assets.
Like the appliances.
Yes, if a piece of machinery, a vehicle, or even a consistent history of paying utility bills or appliance installments can be verified, the regulatory framework must allow banks to recognize that as a legitimate proof of reliability, lower the requirements so that informal assets actually count.
You have to recognize the wealth and the discipline that already exists in the informal economy, even if it isn't printed on a standardized W-2 form.
And finally, expanding national credit registries to include non-financial data. If your history of paying a cell phone bill or a washing machine proves you are trustworthy, that data should be visible to the entire financial ecosystem.
Granting you access to better rates and broader opportunities.
Exactly. The grand takeaway of this study is that financial access is not merely a niche banking issue. It is a fundamental mechanism for activating the dormant life force of a nation's most vulnerable people. It creates real, tangible social mobility through the labor market.
When you synthesize the entire journey, it is staggering. By simply offering a $5 minimum savings account and providing a $250 loan backed by a guy on a motorcycle, asking your neighbors if you're reliable, they altered the fate of hundreds of cities.
It's incredible.
They saved uncounted, undocumented businesses from collapse. They pulled marginalized people out of unemployment. And against all the rules of traditional capitalism, they actually shrank the wealth gap by enriching the bottom tier of society while the top tier stayed exactly the same.
It's definitive proof.
It really is definitive proof that the 70% aren't poor because they lack drive or capability. They are poor because the door to the system is deadbolted from the inside.
And the data shows that the moment you unlock that door, the sheer economic energy released by that population is powerful enough to alter the GDP trajectory of an entire nation.
Which leaves us with a truly chilling, provocative thought to chew on as we wrap up. We have just spent the last hour dissecting the year 2002. We talk about handheld computers, physical appliance stores, and guys riding motorcycles through dirt roads to look you in the eye.
It was highly physical and deeply human.
Yes, very human. But today, we pride ourselves on being infinitely more advanced. We talk about AI credit scoring, digital wallets, blockchain finance, and decentralized ecosystems. The prevailing narrative is that high-tech is democratizing finance.
But is it actually democratizing access, or is it just automating the exclusion?
Exactly. Think about how modern digital redlining works. As our systems get more, quote-unquote, advanced, are we actually just building higher, totally invisible walls? If an AI algorithm scrapes your digital footprint, looks at your zip code, your browsing history, and decides you don't fit its perfect mathematical mold for a loan, you are instantly rejected.
And unlike 2002, there is no guy on a motorcycle coming to your house to see your actual situation.
There's no one to ask your neighbors how hard you work. You are just a zero in a database.
It removes the human context from the assessment of risk. The informal economy is messy, it is human, and it doesn't fit neatly into digital categories. If our modern financial tech demands perfect digital conformity, we risk recreating the exact same exclusionary environment that existed before Banco Azteca intervened.
We might be accidentally locking billions of people out of the global financial system all over again, simply because their messy physical lives don't translate into the shiny new algorithms we've built. History, as proven by this incredible data out of Mexico, shows us exactly what happens when you finally let the 70% into the room. The terrifying question we have to ask ourselves today is, are our brilliant new machines about to shut them right back out?